You are about to buy shares in the largest stock market debut in human history, and you probably do not even know it. A nearly $2 trillion financial machine has just been quietly re-engineered behind closed doors to guarantee your participation. Welcome to the SpaceX IPO. You have been sold a captivating story about colonizing Mars, limitless satellite internet, and participating in the next giant leap for mankind. But the reality of what is about to happen on the stock market is much colder, much more calculated, and frankly, a little terrifying for the average investor. When the opening bell rings and the price jumps, millions of people sitting in their living rooms will tap buy on their phones, terrified of missing out on the wealth creation of a lifetime. They will look at the flashing green numbers and feel confirmation that they made the right choice. But let us look at the psychology of what is actually happening in that exact moment. The pop you celebrate on day one is not proof that the stock is a great investment. It is simply the sound of risk changing hands. It is a massive relay race, and the baton is being passed from the insiders who secured their cheap seats years ago directly to the public. You might feel like you are getting in early on a revolutionary company. Mechanically, you are getting in last. To understand why this is a wealth trap, you have to disconnect your emotions from the rockets and look at the anatomy of the business you are actually buying. If you ask the average person what SpaceX sells, they will tell you they build spaceships. But SpaceX is actually three completely different businesses stacked on top of each other, and the rocket launches are not even the main event. The first business is Starlink. This is the crown jewel of the entire operation. It is a satellite internet provider that essentially acts like a massive telecommunications monopoly in space, boasting over 10 million active subscribers across the globe. This division is highly efficient, pulling in over $11 billion in revenue recently, which accounts for more than 60% of the entire company's sales. More importantly, its profit margins are rapidly accelerating, bringing in over $4 billion in operating income. Then you have the rocket launch business. It brings in billions and commands all the media attention, but it is growing slowly and represents a surprisingly small slice of the overall financial pie. And finally, you have the wild card. Earlier this year, SpaceX absorbed an artificial intelligence lab in a massive all-stock deal. While the narrative around artificial intelligence is incredibly hyped right now, this specific division is currently functioning as a giant furnace, burning through roughly $1 billion a month. When you combine these three divisions, the financial reality becomes stark. In a recent year, the consolidated company generated roughly $19 billion in revenue, but ended up losing nearly $5 billion. When you buy a share, you are buying one brilliant, highly profitable engine, towing several massive, money-losing train cars behind it. And yet, the price tag being attached to this train is absolutely astronomical. The target valuation for the public debut is $1.75 trillion. Let that massive number sink in for a moment. That makes it more valuable than almost any other company on Earth, effectively pricing the business at 94 times its current revenue. To put that into perspective, highly successful, mature technology giants usually trade at a tiny fraction of that multiple. Less than a year ago, private investors valued this exact same company at around $400 billion. The fundamental business did not get 4 times better in 11 months. The rockets are not 4 times faster. The satellites did not miraculously multiply by 4. What got 4 times more expensive was the story. Let us look at the cold mathematical reality of what it would take for you to simply break even on an investment at this inflated price. If you just bought a boring standard index fund, you could historically expect around a 10% return per year. For SpaceX to give you that exact same basic return over the next 10 years, from a starting line of $1.75 trillion, the company would need to reach a valuation of $4.5 trillion. To justify that financially, they would need to pull in over $500 billion in sales, growing their revenue by an astonishing 41% every single year for a decade straight, without a single misstep. Almost no technology giant in human history has ever achieved that from a starting base of $19 billion. At the target price of $135 a share, you are paying entirely upfront for a financial miracle, and you only get an average return if that miracle is executed flawlessly. But here is where the story shifts from a simple case of overvaluation to something much darker. Remember when I said, you will be buying this stock whether you want to or not? The financial system has quietly bent its own rules to roll out the red carpet for this specific debut. Usually, when a company goes public, there is a strict waiting period of at least 3 months before it can be added to major indexes like the NASDAQ 100. This seasoning period exists for a very important reason. It allows the open market time to figure out what the company is actually worth before passive retirement funds are legally forced to buy the stock. But just weeks before this launch, those safety rules were changed. A new fast entry rule was introduced that compresses that 3-month waiting period into just 15 trading days. On top of that, the minimum requirements for how much of the company must be publicly available to trade were effectively erased. Even more absurdly, a hidden multiplier was introduced that forces index funds to treat the available public shares as if they were 3 times larger than they actually are. This is carefully manufactured demand. If you hold a basic index fund in your retirement account, the mechanics of passive investing dictate that billions of dollars will automatically flow into this stock at whatever inflated price the market has set. You do not get a vote on this. You do not get a choice. You will become a guaranteed buyer. And who exactly are you buying these expensive shares from? The insiders. Retail investors are being allocated 30% of the supply in this offering, which is drastically higher than the typical 5 to 10% seen in normal public offerings. While company executives might claim this is simply to reward loyal supporters of the brand, the wealth mechanics tell a completely different story. This debut is structurally designed with a series of timed releases. Insiders and early investors cannot sell all their shares on day one, which prevents the stock price from instantly collapsing. Instead, their shares unlock in designated waves over the following months. Notice the chilling perfection of this timing. Just as the initial public excitement fades and the breathless media headlines disappear, a massive new supply of insider shares will flood the open market. And right on schedule, those newly modified index rules will force passive retirement accounts to automatically absorb that exact supply. In the cold, unglamorous terminology of Wall Street, ordinary retail investors and their passive retirement accounts are being actively positioned as exit liquidity. The propped-up opening price is not a floor protecting you. It is a launch ramp for the people getting out, and you are the one providing it. There is a profound psychological difference between a remarkable, generation-defining company and a good investment. SpaceX is an undeniable triumph of human engineering. It launches more rockets than entire nations and operates a communication network that literally spans the globe. But a great company bought at a terrible price is still a terrible investment. History tells us a brutal truth about these massive, hyped-up public offerings. Over 90% of them eventually trade below their absolute worst price on opening day. A strong open tells you nothing about the future of the asset. It is just noise, and noise is the one thing you should never hand your hard-earned money to. The smartest investors in the world do not let a loud countdown clock dictate their wealth strategy. They prioritize proven systems and discipline over short-term emotional outcomes. They understand that true wealth is built by letting time do the heavy lifting, not by sprinting into a marathon just to buy on day one. If you truly believe in the long-term future of this business, patience costs you absolutely nothing. In a few months, the forced index buying will have run its course. The waves of insider selling will have washed through the market. The company will have to report actual, verified quarterly earnings, and the stock price will finally be set by cold reality rather than manufactured hype. You do not have to be early to do extraordinarily well in the stock market. You just have to be disciplined. The narrative you are aggressively being sold right now is that this is a fleeting, once-in-a-lifetime chance to get in on the ground floor. But the penthouse of this building was bought years ago, and those owners are currently looking for someone to buy them out at a massive premium. So here is what you need to ask yourself before that opening bell rings. Are you investing in a fundamental business based on its actual numbers? Or are you just paying a massive premium for a story you desperately want to believe in?
Like, share, and subscribe for more videos. Thanks for watching.